Alright traders, today I'm giving you my favorite setup, the most simple setup you can use in the stock market to get those reversals and enter for hopefully those easy profits. And this is one that anybody can find, anybody can do. Just looking at this one chart, let me scroll through, show the exact moments this happened. As you saw by the video title, we're going over double bottoms, and double bottoms are just a high likelihood place of a bounce. And who knows how far it's going to go. It could go back up to all-time highs, could go to the high of the week, but the entry point on a double bottom is nonetheless the best. Here's a double bottom there, here's a double bottom there, and this is just the SPY. In the last 6 months, we saw huge amount of double bottoms, great entry points if you wanted to go long on the SPY. Right there, double bottom. There's so many entry points you could have used just in the last couple months, and these led to major reversals. Here's another double bottom, and as I scroll down and down and down, you're going to see we have this V-shaped dip, which also leads to a double bottom from the past. So let's scroll on and let's look to see how to play them. And first off, the psychology behind a double bottom, just if you're curious on how it works out and why it's one of the greatest patterns we find, is once the stock market dips and finds a price level it's supported at, we know that there's buyers there. These are for the drops in the market. There's buyers there. So if it drops there again in the future, we know there's probably going to be buyers, again, defending that area. So typically, that area is a place of demand, a demand zone as we call it in the market. And whenever we touch a level twice, it's less likely to break down. 3 times, now we're talking about a possible break through that level and the demand just falls and we get that drop and not support. So we like to play double bottoms. We don't like to play triple bottoms for support. We like to play triple bottom breakdowns, but that's for another video. So again, we're just showing you the double bottom and we're going to show you exactly how it's done. So right here is the first huge V-shaped bottom on SPY. And this was a 4% pullback. So that is our level that we're going to watch in the future. If we ever hit that again, we know to get entered on that. So I'm just going to draw a line on that. And what you see is the body of the candle. That's where we put our line. And a lot of people ask that question, the wick or the body, which one do I use? The body is where people close the price on that day, on the 4-hour candle, on the weekly candle. So we know it's where people decided that's the most important price. It's the low of the day sometimes or the high. So we're going to put it there. And as you can see, the next candle that dropped to this level didn't touch the wick. So we saw a touch of the body and not the wick, just proving my thesis on the body being more important than the wick. I'm going to make the wick a dashed line just in case we head down there. So we want to have price action. This is pretty important, further away from past price action. And this just means that if you have I'm going to put a rectangle up on here. Let's put this area here. And let's just extend it over. And you can see this is our buy zone. And we haven't had a touch of this level for a very long time. So this is the first low in the market that's happened in quite some time. So we know this is an aggressive low and there's a lot of buyers in there because it hasn't been touched in the past. So we had a small touch back here, but if we're further enough away from past price action, it's considered not chopping. This is considered an actual trend down in the market, a short-term trend. The worst thing you want to do is place your double bottom right here, and that's going to be your place where you're going to buy. Because as you can see, we came down here once, we came up, we did double bottom, so that honestly would have been a great entry point. But we come down here, we triple bottom, come down here, quadruple bottom, and gap down. If you're playing something that is too close to past price action, and if I just look at the candles to the left of me, this low right here is about 4 candles away from the previous low over here. It's just not enough distance, not enough time, and not enough up and down dollar amounts. So if it's too close, it's considered choppy. We don't want to play choppy, but honestly, just look at all those bottoms off of this section. So there's a true double bottom right there. And let's go over a true triple bottom. And I mean, you could have day traded this one, but this one wouldn't worked out. You would have gotten stopped out the next day, but that one hit it for a fourth time. So yeah, if you pick that level, it worked out. But again, just know the closer you are to price action, the more chop there is and the more it could break down. If we're further away from price action, like I said, just look at all this distance of nothingness. This nothing burger, we're going to call it right here. We'll make this yellow, turn it yellow. You can see we have no price action for a very long time. We know this is an aggressive low that is likely to come through it again and reverse if we ever touch the decided bottom on that candle. So as we look towards that candle bottom, we touch it to a T, we gap down in the market, and we come down and hit it exactly. And what you want to do is you never ever want to buy on the first touch of something. You want to wait for some consolidation at that zone, because the only way it's going to hold this level is if buyers come in and they pick it up slowly throughout the day. Maybe it takes like 30 minutes, an hour to consolidate. But the more you accumulate here, the more we know that the buyers are defending it. If the buyers don't defend it, it could take a 20-minute candle, boom, and we crash through on the next candle. So let's just scroll into the 30-minute chart and let's see exactly what it looked like on that day. So as I scroll in, what you see is the perfect candlestick patterns. So a lot of wicks. Yeah, you can see 3 wicks right there, tiny bodies. Those are the ideal candles for a reversal. And we have that double bottom perfectly tapped on there. So those candles hit it twice and came off of it. You generally want to buy something after a couple candle confirmation of the bottom. So you could have bought it on the first touch, second touch, or third touch. But again, the longer you wait, the better. And if you are further enough from past price action, you have a nice range you can fly through. You don't have to rush to get into this, because look at, you had about a whole 3 hours later, you could have got back in. Even the next day, you could have bought the dip. But again, those initial candles, you got to be very patient. Anything in a trade, you're not buying the first dip. You're not buying the first candle. Always wait. You have time in your trade. You don't have to jump right in once you see that level get hit for the first time and you see that breakout happen on that first candle. You don't need to. You can be very patient. If I scroll this over, you can see that that next level we gapped over. It's kind of funny. So yeah, that double bottom was a charm. And you can see that the candle body held on the 30-minute. We came down, lots of wicks on the 30-minute, and then boom, we're off to the races. So overall trend in the market is up. So if I just go to the chart here, you can see we've been trending in the market for a very long time. If you're curious on what the trend is, just change these to Heikin-Ishi candles, and we've been trending for a very long time, mostly green. If you head to the weekly chart or the monthly chart, they're all green candles. So you're much more likely to get that double bottom to pop if you have a great overall trend, or that double top to come down if you have that trend coming down. So again, going with the trend is always what the best traders do. And you have a much more likelihood chance of getting that bounce if you are going with it. Let's go through one more example down here, and I'll leave you guys off to hopefully do this live. But there is, man, we have so many bottoms on this. Here's one bottom that is pretty far from past price action. And again, I'm going to put the first level at the candle body and the next level at the candle wick. And you can see in the past over here, we bottomed right off the body, bottomed right off the wick that time. So the wicks are going to retest levels, but the candle bodies are going to define those levels, just like what we saw in the past over here. So you can see that was a great bottom. That was a huge wick. If we look in the future to where this was going to come down to, we do see that candle body and that wick holding right about there. So let's try to zoom into the 30-minute chart and see how we would have played this on that day. So we don't know it's going to hold. So it's always a question mark. Is that the level? That is the bottom. And to confirm that is the level, what we need is a lot of candles to support around there. So if you're looking at the market, there was one point where you could have bought this level right here. I think it was around here. You had 3 candles in the morning supporting it, a lot of wicks, but then the next candle blows right through it. So we don't have too many great candles there, and the more candles you have, the better. If we look over here, how many candles do we have at this level? We have 1, 2, 3, 4, 5, 6, 7. 7 total candles supported on the level. What you could have done is take the gap up the next day and bought in there, or you could have bought in at the 3rd or 4th candle. So once you find your bullish candle, right here's a nice hammer inside candle, that's where we could be getting in, or we could be getting in on the breakout. So anytime we break in an inside candle range is a perfect entry point. So this candle breaks out, goes over the range, and then we finally get that run. So depending on where your stop loss is, great entry point. And the more inside candles, the better. And what you're also looking for is higher lows. So higher low, higher low, higher low, higher low, higher low. A lot of higher lows, even to the next day. Look at all these. Higher low, higher low, higher low. Even on this trend, you see a lot of higher lows. And that shows us that there was just a lot of bullish momentum at the bottom. And the buyers were really winning this war because they were producing those higher lows. So there's the double bottom. That's how we trade it. That's why it's one of my favorite setups. If you want to see a playlist on my past technical analysis videos, check it out in the video to the right of me. Peace out, traders. Have a great day.